You're listening to the Economics and Country Risk podcast from S&P Global Market Intelligence. In each episode, our experts will provide you with the where, how, and when to make decisions that transform your business.
Everyone, thanks for joining. The Global Economics team will present our top 10 predictions for 2023. I'm Chris Farveris, co-head of U.S. Economics and the moderator for today. Our other panelists are Sarah Johnson, Executive Director in Global Economics, Todd Lee, Executive Director and Chief China Economist, Joel Prakken, Vice President, Chief U.S. Economist, Ken Wottrick, Vice President and Head of Europe in Economics and Country Risk. I'll introduce the predictions and get some commentary and discussion amongst our panelists. In the interest of time, we'll discuss only 8 of the 10 predictions. So now briefly to set the stage for the look ahead to 2023. So what are the initial conditions that we find ourselves with today? Well, still elevated inflation that's well above central bank targets. Commodity prices are falling and pulling goods inflation lower, but wage inflation and services price inflation remain persistently elevated. Central banks, as a result, are stepping on the brakes, leading to slowing growth. The U.S. and Europe are on the cusp of recession, if not already in one. And meanwhile, supply chain issues, while much improved, are not entirely resolved. In part, COVID lockdowns still exist, and COVID's still circulating and mutating, and the war in Ukraine grinds on. So this brings us to the first of our 10 predictions. We expect that COVID-19 will continue its transition from pandemic to endemic, allowing for remaining lockdowns to be eased. The implication being that COVID will impose progressively less drag on the global economy, whether through lockdowns or withdrawal of workers from the labor force. Second, we expect no major departures in the status quo in the Russia-Ukraine war. So that implies we don't expect spiking commodity prices or other significant disruptions to global trade or finance of any economic significance. Our risk team thinks a ceasefire is possible, but not before summer at the earliest. And even if that does occur, it won't impact sanctions, so it's unlikely to have much impact on commodity prices. On the other side, we're not expecting an escalation that would cause a spike in commodity prices either. So, of course, with respect to any of predictions related to the war, the confidence bands here are very, very wide. So our next 4 predictions are as follows. Inflation will slow significantly in 2023, but achieving central bank targets will be a multi-year process. Number 3, global monetary tightening is further to go during the first half of 2023, although with much regional variation. Number 4, we expect mild, short recessions in Europe in late 2022 and into 2023, with the U.S. not far behind. And APAC remains resilient, benefiting from the region's more recent COVID reopening. Number 5, housing markets will decline in the face of rising mortgage rates, but home price corrections will be tempered in some markets by still tight supplies relative to demographics. All right, Sarah Johnson, our prediction with respect to global inflation is that there'll be a fair degree of stickiness. That is, it's not going to come down as quickly as many hope. Why is that?
Well, you're right, Chris. We won't declare victory over inflation in 2023, but we will make significant progress. We expect inflation will moderate in response to tightening financial conditions, softening demand, and easing of global supply conditions. But downward pressures are already in the pipeline. If you look at the S&P Global Market Intelligence Materials Price Index, a very comprehensive indicator of industrial commodity prices, that index has fallen 30% since its peak in early March. So we're already beginning to see some easing of prices of intermediate goods, and it's coming for finished goods as well. We expect that global consumer price inflation peaked in October at around 8% year on year, and it will ease throughout 2023. Some of this reflects base effects. Many of these commodity prices had doubled year on year ago, and we won't see that again. So after picking up from about 4% in 2021 to 8% in 2022, global consumer price inflation is projected to ease to 5% this year and 3% in 2024. If you look at where we stand in December, we'll probably see global inflation around 3.5%. But I would note that Inflation has been broadening out. We're seeing more inflation in services. If you look at core inflation rates, they're not yet declining. And that reflects pressures from labor markets. Labor is in short supply. That's contributing to more inflation in services, along with the energy price increases. So bottom line, it could take a few years to bring inflation rates down to the typical central bank target of about 2%.
So some stickiness in wage inflation is at work here, potentially slowing the disinflation.
Yes, very true. Wage inflation tends to lag price inflation. And as a result, we are seeing some acceleration in wage rates. And there are a number of reasons for this. One is labor supply. The pandemic has left a legacy of kind of weak labor force participation. There's been what's called the Great Resignation, in which more people left the labor force. We've also seen worldwide less mobility of labor from country to country, either immigration or the flow of guest workers or seasonal workers due to the pandemic. And so as a result, there have been upward pressure on wages. We expect this will persist into 2023, but keep in mind, central banks have their eye on wages. They recognize this is a situation in which unemployment rates will have to rise a bit to cool those wage pressures. And we indeed see unemployment rates rising globally, and particularly in the United States and parts of Europe. This will indeed cool wage pressures.
Yeah, so that's a great segue to the attempts of central bankers to squeeze inflation back down to acceptable levels. Ken Watrett, these are challenging times for the Fed, the ECB, the Bank of England, as well as central banks in developing economies. Can you give us some color around our monetary policy forecasts and explain some of the risks?
Absolutely, Chris. So as you mentioned at the beginning, Chris, in summary, we believe monetary policy tightening has some way further to go, particularly in advanced economies, out to the spring, but prospects really vary depending on the country or region that we're talking about. We start with the US, as inevitably we do. We expect the Fed funds rate to peak at close to 5% next spring, 100 basis points or so north of the current level, though the size of the increases is forecast to moderate compared to the recent exceptional run of 75 basis point hikes. Now, that expectation broadly matches what's currently discounted in futures markets, though we see the risk probably tilted towards the Fed maybe doing even more, given the need to create some slack in labor markets to keep a lid on pay pressures, as we've just been discussing. Now, when it comes to the ECB, our view diverges from market pricing in the other direction. ESTA futures currently discount a peak in the ECB's deposit rate of 2.75%, but only in Q3. Now, that expectation has shifted down recently. It was even higher not so long ago, but we still think that expected peak is both too high and too late. Now, we acknowledge the ECB's been playing catch-up recently, also delivering unusual 75 basis point increases. And that's because it started its hiking cycle comparatively late. And then at the next meeting in February, another rate hike, though this time of 25 basis points. And that's where we expect the rate hikes to stop. The terminal rate, deposit rate of 2.25%. So quite a bit below current market expectations. Why do we differ? Well, a few reasons why. One is we expect that the neutral policy rate in the Eurozone is significantly lower than in other economies, particularly the US, for example. We have forecast of an imminent consumer-led recession, and we see relatively low risks of wages spiraling. Again, differences in labor market conditions compared to other parts of the world play a part in that. Now, for other central banks in the region that typically shadow what the ECB is doing, the picture is pretty much the same with some minor variations subject to exchange rate developments, but there are some exceptions in Europe, and one of those is the Bank of England. When it comes to labor market trends and potential pay pressures, the UK situation looks more akin to that in the US than in many parts of continental Europe. That argues for a higher peak in policy rates than we forecast for the ECB. Though that said, we've got a UK recession already underway. We've had a fiscal tightening announced recently, and we think the Bank of England is sensitive to worries about a housing crash. And so we expect the peak for bank rate to be at 4%. So well north of where the ECB is forecast to stop, but some way below where the Fed is expected to stop.
That's great. What about the prospects for rate cuts? Where do you see the greatest scope for policy easing, and when might that begin?
We think we're at an inflection point for some central banks, or pretty close to it. So in our base case, the easing cycles are forecast to be most pronounced and begin earliest in Latin America. And that's because many of the region's central banks bit the bullet and tightened policy relatively early and substantially as inflation soared from 2021 onwards. We also see scope for rate cuts in parts of emerging Europe relatively soon as well, another region where bigger, earlier rate hikes were delivered in response to soaring inflation. Cuts there are generally forecast from the second half onwards, though where there's political pressure on central banks to ease, we're seeing scope for earlier rate cuts, including in Russia, as an example. We're not expecting the Fed to reverse course until it's confident that inflation will decline towards its 2% objective, implying easing only from 2024 onwards. So that would disappoint current futures market expectations of cuts. And in broad terms, we have a similar view of the ECB rate cuts starting in the spring of 2024, taking the depot rate back to its estimated neutral rate of 1.5%.
Thank you, Ken. So achieving the proverbial soft landing has always been difficult, and it's doubly difficult in the face of the extreme supply shocks such as the global economies experienced this year. Joel Prakken, we're forecasting the U.S. to slip into recession in the not too distant future. What's behind that, and how bad will it be?
So there's been a significant tightening of financial conditions over the course of 2022. The Fed, as Ken just described, has raised its policy rate from 0 to 3.5%, and there are more rate hikes coming through the spring. Treasury term yields have risen approximately 200 basis points, with recent portions of the yield curve now inverting. Spreads to corporate bond yields and mortgage rates have widened significantly. Stock prices have slipped about 15%. The real trade-weighted dollar is appreciated about 10% over the course of the year, and house prices that were surging decelerated sharply at mid-year and now are declining. So against the backdrop of waning pandemic-era fiscal support and allowing for the usual lags, we're expecting this general tightening of financial conditions to tip the U.S. economy into a recession in the first half of 2023. This recession is going to be mild by historical standards and brief. We see a peak-to-trough decline in GDP of just 0.5%, with the recovery starting in the third quarter and the unemployment rate peaking just above 5%. It's going to be concentrated in construction, both residential and non-residential, and in spending on consumer goods, but there will also be a modest inventory cycle thrown in there as well. It's going to be a mild recession because there are no big imbalances we see in the economy begging for correction, because household balance sheets are quite strong, and because we expect a counter-cyclical increase in vehicle production as chip shortages ease around the world.
Thanks, Joel. Ken, you've been writing about the tough sledding ahead for Europe, it being the epicenter of shocks to commodity supplies and prices stemming from the Russian invasion. How would you characterize the expected European recession?
In our base case, it would be characterized as relatively short and relatively mild. So we're expecting a recession in the EU and the euro area over 2 quarters, driven primarily by similar factors that Joel described, but in particular from a spending perspective, weakness in the consumer side of the economy. And that reflects the extreme squeeze on household real incomes due to soaring inflation. Our forecast will be updated, and in the new baseline, we'll likely incorporate peak to trough declines in euro area and EU real GDP of somewhere between 0.5% and 1%, which is quite a significant drop, but relatively shallow compared to almost all of the recessions that we've seen in the euro area and the EU since the early 1990s. There is one obvious downside risk in Europe, which is the potential for energy shortages, leading to much more severe recessions, though those have also receded somewhat recently for a number of reasons. High storage levels for gas, for example, alternative sources of energy supply, and so on. And one thing I should highlight, it's important, is, of course, Europe's not the same. It's very different depending on where you look. So our forecasts of national real GDP contractions across the region vary due to differences in sensitivities to some of the key headwinds that we're looking at. Things like, differences in energy mix, sources of energy, differences in policy support, and so on. Now, of the larger economies that we're forecasting, we're expecting Germany, Italy, and the UK to underperform for a multitude of different reasons.
Thanks, Ken. So let's pivot to Asia. Todd Lee, we're predicting that growth in Asia broadly will be something of a counterweight to the recessions in Europe and North America. Why is that?
Yes, Chris. We expect APAC to will fare better. First, because the inflation in the region is generally milder than in the US and Europe. So monetary policy in the region is looser than US and Europe. Also, APAC's pandemic to endemic transition happened later than US and Europe. So we're expecting lingering pent-up demand, at least into early 2023. Also, our PMI survey suggests that a lot of employers are actually keen to retain workers after the labor dislocation caused by the pandemic. And also the pandemic has delayed a lot of major infrastructure projects. So we expect resumption of these projects around the region. Also with reopening these mega trade deals that were signed in the last couple of years, we'll finally be able to strengthen intra-regional trade.
All right, let's turn to our next three predictions, number 6, 7, and 8. So number 6, the US dollar is likely already peaked and will slide over 2023, but it will remain elevated compared to prior years. Number 7, emerging and developing economies will remain resilient during 2023 with pockets of vulnerability. And number 8, China will gradually exit the zero COVID policy in 2023. Sarah, start us off again to explain the thrust of our exchange rate predictions. Why is it so hard to get the direction right, let alone the timing?
Yes, you're right, Chris. Forecasting exchange rates is very challenging. And I think if you look at the past 6 months, we've seen a lot of volatility in financial markets that is echoed or amplified in currency markets. But our view is that the dollar has peaked. It's not going to revisit the highs of last fall when the dollar reached multi-decade highs against a number of currencies. But we expect strength in the dollar. The rise was supported by very favorable interest rate spreads and investor flight to safety. The U.S. Fed is tightening a little more aggressively than many other central banks, and that situation is not changing. So while we see the trend for the dollar will probably be depreciation, it will be limited during 2023 and might be more visible in the second half than the first half. I'd say clearly the flight to safety phenomenon is not present right now. And other factors, certainly the course of the Russia-Ukraine war is affecting the euro. Ken will talk about the euro and the sterling. With respect to the yen, the appreciation during 2022 was truly exceptional, beyond expectations, and we're looking for a dollar correction, but it will probably proceed gradually. It will just have its early stages during 2023.
Thanks, Sarah. Joel, anything to add?
Mostly just to reinforce Sarah's remarks. Our narrative for quite some time has been that eventually the dollar must come under some downward pressure in the face of unsustainably large U.S. current account deficits. But in the short run, first, the relatively strong fiscal, monetary, and public health responses by the U.S. to the pandemic, and then more recently, the relative insulation of the U.S. from the adverse ramifications of the war in Ukraine has led to a strengthening of the dollar as capital has been attracted to the U.S. But as these factors reverse, we expect the dollar to decline, particularly since right now, the U.S. dollar has been as much as 10% above the values predicted by our models that are based on fundamental concepts such as international interest rate differentials and over longer periods of time, purchasing parity.
Ken, the euro slipped below parity for a bit and since recovered. Where do you see it settling? And I suppose the answer depends in part on how you see the more fundamental terms of trade having been impacted over the medium term.
Yeah, absolutely, Chris. The loss of relatively cheap energy supply from Russia, it looks like a persistent terms of trade shock for the euro area. And we've leaned down on our forecast for the euro against the dollar and other currencies as a consequence of that. Now, in the short term, we've had, a rebound back above parity, quite a strong one, actually, but that's been accompanied by appreciation of the pound, the Japanese yen, So, this is more than just a euro move. It reflects a broader shift in sentiment away from the US dollar, albeit from very strong dollar levels. We see scope for further euro appreciation in the medium to long term, as the current rate is still so far below the long run average, which is about 120. But we've come a long way in a relatively short period of time. And as already outlined, given recession prospects in Europe and our expectation of comparatively low terminal policy rates, we think it will be difficult to sustain the appreciation that we've seen at the current rate. So we're expecting more gradual gains from this point onwards. One other point I'd highlight is that the euro in trade-weighted terms is not so weak. The broad nominal index that the ECB calculates, it's about 5% above its long-run average still. So the euro area has effectively had the worst of both worlds, weakness against the dollar, adding to imported price pressures, and at the same time, not that big a depreciation in effective terms, hindering export prospects. And briefly, just on the pound, similar story in some respects, recovering after being extremely low, but given a number of structural challenges which the UK faces, again, we see quite a gradual appreciation.
Thanks, Ken. Todd, the strength of the dollar and rising rates in advanced economies often spell trouble for emerging markets. Yet our prediction for potential spillovers to those economies appears to be cautiously optimistic. Why is that?
Well, Chris, we think the emerging markets should largely stay out of trouble because based on lessons learned from past crises, these EMs have built up their foreign exchange reserves war chest, also improved their banking sector regulations. So, for example, their banks are much better capitalized than before. Also, they have much better hedging arrangements against foreign exchange exposure. The central banks of many of these emerging markets have better central bank policymaking now. So they've been pretty effective in utilizing interest rate policies and their foreign exchange reserves to balance multiple policy goals like limiting the exchange rate volatility, preventing capital flight, controlling inflation, and also support economic growth. And also the commodity market rally early this year has bolstered the commodity exporting EMs, government's coffers. So these governments are in better financial position entering 2023. Of course, there's still going to be pockets of weakness, and some of the emerging markets and developing economies will likely struggle because their policymaking has been pretty sluggish. Also, they have higher debt loads, and they have weaker external buffers. But still, we do not expect a disorderly default because the possibility of debt restructuring under the G20 common framework.
All right, that's great. I'm going to read our last two predictions. So number 9, supply chain disruptions will ease markedly in 2023 as demand softens and as remaining lockdowns are lifted. Number 10, labor shortages will continue to be a global challenge in 2023, eased somewhat by increasing migration in some countries. All right. I want to thank our panelists. I want to thank all of you. And on behalf of our panelists and all of us at S&P Global Market Intelligence, thanks for joining us today and have a great day.
Thank you for listening to the Economics and Country Risk podcast. Connect with us on LinkedIn and Twitter, and don't forget to subscribe to the podcast so you never miss an episode.